Good morning, ladies and gents. My name is Simon Brown. I'm facilitating this morning. We've got our first Meet the Managers for actively managed certificates. We've got High Street, we've got Boabab, we've got Clucas Gray. Quick bit about the process for how the webcast will work. Each of the three got about 10 minutes to present on their AMCs, their actively managed certificates. Thereafter, we'll have some quick questions. If you've got questions, drop them into the Q&A box. We'll certainly take them as each manager finishes presenting, that they can go and work the rest of their day. But if no questions, we'll send some contact details for follow-up down the line. Before we go any further, I just want to quickly sort of recap actively managed certificates, relatively new to the JSE, about a year and a half or so 2.5 years or so since we've had them available on the market. Couple of important points. They trade on the JSE just as anything else. So you would buy and sell in a normal stock brokerage account. There are market makers who are managing the price. So if you look and you think there's no liquidity or not enough liquidity, there certainly is, and you can always contact the managers, market makers, to get better liquidity. And what we see within an actively managed certificate is kind of think of a ETF, exchange traded fund. Those trade on the JSE. We know those, they've been around for over 2 decades. Yeah, there is one very important difference. The ETF is passive. It's going to track an index. It's going to give you the return of the top 40 or the S&P or Europe or whatever the case may be. And an actively managed certificate, as the name is suggesting, is the managers are actively managing it. So it's kind of like unit trust listed on the JSE. And it has all those characteristics. I think they're absolutely great products. We've seen significant innovation in terms of what's offering. I think we're going to see a lot more of them come to market, and we'll go through with each of our managers, and they will talk to what they've got and how they are seeing it. But first, gents, appreciate all of your time today. Let me get the right screen up. Let's start with High Street. I just want to view that to full screen mode. There we are. We're running perfect there. And yep, perfect. So we've got both Charlie and Christopher from High Street. Chris, I had muted you, so you're going to have to quickly unmute yourself. But gents, the floor is yours.
Thank you for that introduction. Today, as you mentioned, we're going to be speaking to our two offshore AMCs that we have in collaboration with Standard Bank. They are the note issuers. These two AMCs sit on very different sides of the spectrum. So I'll be speaking to our global yield AMC, which is a far more defensive, yielding focused instrument. And then Charlie will be speaking to the Wealth Warriors AMC, or AMC 007, which is a far more aggressive focus here on high growth equities with the long-term goal of capital appreciation. So to dive straight into the global yielding products, the focus here is on companies that are returning large amounts of capital back to shareholders, either in the form of dividends or share buybacks, or in some cases both. So we target a yield of 4+%, and this product is very suitable for more defensive investors who are looking for a more defensive strategy and are primarily focused on developed markets. So the fund does have a defensive element through a value bias. That being said, it does incorporate growth. And you'll see, I think it's on the next slide, holdings such as Microsoft and Alphabet, although traditionally being considered growth investments, they are, in our eyes, still defensive. They have very strong balance sheets, strong returns on capital, and they have superior cash generative ability, which allows them to return the large amounts of cash to shareholders. And as a result, some of those big tech companies are some of the largest returners of capital in the world. So yeah, very, very important for more defensive type products is diversification, whether that be across sectors, across geographies, etc. And you can see there on the left, this product is nicely diversified across those major sectors, with the biggest weight currently in financials. That in itself is diversified. If you delve a bit deeper there, that 15% or so is made up of, for example, UniCredit, which is your traditional European bank. Then we have Visa, which is more on the payments processing side, and diversified financial services. and then also S&P Global, which is a rating agency as well as financial analytics company. So even within sectors, we try to diversify. Then on the right, you can see our holdings and the geographies in which they are listed. If you do just run your eye over those names, you might see that there is a hell of a lot of US names. However, important to consider here is a lot of those names are large multinational businesses with globally diverse revenue streams. So, for example, the likes of a Johnson & Johnson or Visa, they actually get more than half of their revenue from outside of the US, and as a result, it is sufficiently geographically diversified. And so why do we choose this yielding strategy? I think first and foremost, we're always looking for performance, and historically, these yielding strategies have outperformed the wider markets. We did a bit of a case study here looking at the S&P 500 versus two prominent yielding strategies represented by the Dividend Aristocrats Index, which is basically just the largest dividend payers within that index, and the Buyback Index. And as can be seen, those yielding strategies do significantly outperform that wider index in the S&P 500. On top of that outperformance, and a large selling point of the strategy is that they generally outperform during market drawdowns. Why is this? It's because these companies that return large amounts of capital are generally defensive. They have strong business models and predictive cash flows, and this allows them to endure through your drawdowns and market turmoil. Okay, so I think everyone has a grasp on dividends and exactly how they work, but slightly less understood is buybacks. So the basic premise here is that a company buys back its own stock. As a result, the number of shares outstanding decreases. So if you continue to hold your same number of stocks, your proportionate interest in that company has effectively increased. And for many years now, Apple has been the poster child. Over the last 10 years or so, they bought back almost $700 billion worth of stock, which is just a staggering amount. It stacks up to around the 12th or 11th biggest company on the S&P 500 today. But most importantly, that's resulted in their shares outstanding decreasing by over 40%. And that has been a large driver of the share price movement we've seen over that period. That last point is important. Despite returning all this capital to shareholders, they're still able to reinvest back into the business. You can see their R&D, research and development spend of over $30 billion per year. So they're able to maintain that competitive advantage and grow revenue while still returning significant cash back to shareholders. Okay, just to conclude here, you can see the performance of the AMC on the left-hand side. There's no hiding from it. We have underperformed the benchmark. However, I think a bit of context is important here. If you look at the fund's launch there, it's December 2022. Since then, since the beginning of 2023, we've basically been in a bull market with the index performance really being driven by your tech darlings such as Nvidia, etc., the likes of which we have limited exposure to in a more defensive yielding product. And just to take that a step further, if you look at, for example, what the Dividend Aristocrats Index has done in that time, it's given you about 6.5% per annum. So yeah, that's more representative. And when Charlie speaks to Wealth Warriors, you'll see how that fund is highly levered to the growth names, and as a result, it's performed extraordinarily well. So just to finish here, this AMC offers you diversified exposure to developed markets, and importantly, it offers a strategy that mitigates against major drawdowns, which is quite prevalent in the current environment. And a prime example of this was this year. You saw the S&P and the NASDAQ each down around 20%, where this fund was only down around 5% over that period, which really drills home the main selling point of this AMC. Thanks, and I'll hand over to Charlie to go through AMC 002.
Thanks, Jen. Charlie, floor's yours.
Thanks, Chris. Thanks, Simon. And hello, everybody. Oh, sorry, it looks like the feedback is coming from my end. but I'll carry on. So this product is fairly new. It was launched in the back end of 2022. So like most AMCs, it only has around a sort of a 1.5-year track record. But it's actually based on the Wealth Warriors Fund strategy, the strategy rather is based on the Wealth Warriors Fund, which was established in 2017. It's designed for South African investors who are looking for a capital appreciation with a higher risk tolerance. It is slightly more volatile than other strategies, which is why we recommend a 5-year investment horizon so that investors can sort of ride up market movements. It targets global companies that are driving technological innovation and changing consumer behavior. Same as the other AMC 002. It's also registered with Standard Bank and has a TER of 1.1%. So Wealth Warriors offers exposure to 8 distinct themes, which are shaping the future of technology and driving consumer trends. So as you can see, the leading theme within this fund is cybersecurity at 24%, but it also takes large exposure to both semiconductors and big tech. We identify themes based on their ability to change consumer behavior and drive technological innovation. And the product does aim to be invested at all times. Just before we move on, it is important to note that there's a big difference between an exciting theme and an investable one. Any investment that makes its way into this product must first pass a strict checklist of non-negotiable company fundamentals. So yeah, it's essential that a theme is both investable as well as exciting. So I think next we can take a look at a bit of a deeper dive into one of the themes. Unfortunately, we don't have too much time today, so we've just picked our largest theme, cybersecurity. That chart on the left is the actual, in the sort of darker blue, worldwide cost of cybercrime in trillions of dollars. And then in the lighter gray is the forecast. So just to sort of put $13.8 trillion into perspective in 2028, this is expected to be around 40% of US GDP at that time. So it's an enormous cost globally to businesses. And I mean, both a sort of fascinating and terrifying statistic is that 90% of the world's data is expected or estimated rather to be generated in just the last 2 years. So this rapid digitalization is fueling an exponential growth in cybercrime. Worldwide, there are just more and more access points created every day. Digital agents, AI agents exposing a number of endpoints. So cybercrime is increasing both in its frequency and also its severity. The average cost globally is expected to be around $4.9 million per breach. And that cost is not just sort of a monetary cost felt by businesses, but also cost in terms of time, in terms of reputational damage. So it's a very significant issue. And that cost is expected to be even more in developed markets at around $9 million per cyber attack in the US. So ultimately, cybersecurity is now becoming a non-negotiable cost of doing business, and is a theme really being driven by the global digitalization we've seen in the last decade or two. Finally, sorry, just to sort of highlight that point even further, the World Economic Forum recently released their global risk report for 2025. Cybersecurity is listed as the 5th most severe risk in the short term over the next 2 years globally, and then also 9th in terms of long-term risks. So a massive problem that these businesses invested in the fund, that the fund invests in, has an ability to solve. So to conclude, the AMC 007 strategy performed very well since inception, 46.5% versus 27%, being driven by those same forces that Chris mentioned earlier. And while this isn't the longest time horizon or track record, rather at 1.5 years, it is based on a well-proven strategy in Wealth Warriors, which has returned well since listing in 2017. It offers an easy, cost-effective way for South African investors to get exposure to these world-leading companies through a rand investment. And with that, we're happy to take any questions.
Thanks, gents. One question's come through from Adam. Chris, probably for you, talking around share buybacks and some nuances. In fact, a second one's come through on buybacks. Better use of capital rather than investing into the business for growth. Chris, I suppose in your example with Apple, they've got sufficient cash that they can actually do both. If a company's buying back shares at the sort of instead of growth, that might be a concern.
Yes, exactly, Simon. As we saw, they're still able to invest $30 billion a year back into the business. And that is a common criticism of share buybacks, is that they may come at the expense of the company's future growth. However, those large internal expenditure, MMA, those all come with risks. If you look at MMA, I think the stats, over 70% of MMA fail to create value, whereas in our eyes, buybacks generate a very safe return on capital. And in the likes of the Apple, they're still spending enough to grow the business organically.
Yeah, no, I agree with you. I'm actually just writing something about M&A, and every time I write about it and dig into it, it just gives me more horrors, cold chills in many cases. I'm not seeing any more coming through for High Street, so we'll leave that there from them. Gents, appreciate your time this morning. Someone's asking if we're recording. We are. It'll be up in just one lap on our YouTube channel. If I can say late this afternoon for everyone. But let's move on to our next. We've got Boabab. Sandy, you're up next.
Sure. Thanks, Simon. Yes, I've just, the first three slides, Simon, are just a little bit of background about Baobab, which I'm not going to spend any time on, but I think it is relevant in the fact that we're a small manager, we're a boutique manager, and what that is particularly relevant for the AMC and what we're trying to do. So I've shown our track record, but more important than the track record is how that has been generated on the third slide, which just shows you that we've generated our track record by taking advantage of our size and investing in sort of under the radar smaller companies that a lot of larger managers or won't be able to invest in or won't appear in an index. And then moving on to the Baobab Equity AMC, which is AMC 009. So it's a new AMC. It's only been going. It was launched late 2023, and really the reason why we launched it was, as everybody on this call will know, there's been a large move towards passive and semi-passive investing in the industry, and we just thought it was very timeless to launch a product that was truly active, and it was actively seeking to invest in areas that a lot of investors weren't getting exposed to. So if you go on to the next slide, Simon, we think the long-term opportunity is very compelling for very differentiated active management. And in putting the AMC together, on the next slide, Simon, we think it's a fairly unique combination in that it effectively takes the best ideas of two very active managers and combines them in one portfolio. And important to stress that, they're both managers, myself and Andrew, while we're not setting out to try and be different, but we are prepared to be different and applying that in the individual parts of the portfolio. So what the AMC is, if you go on to the next slide, if 100 Rand gets invested in the AMC today, 60 Rand of that will go to Baobab, which I will manage. And this will be effectively a portfolio of our very best local and global ideas. Those local and global ideas would be determined purely on a bottom-up basis. So it's not that it's split 50% down the middle, 30% in each. We will invest where we see the opportunity set. So this portion of the portfolio will be usually about 20 to 25 stocks of our best local and global ideas. At the moment, it's fairly evenly split because we're finding lots of opportunity in under the radar stocks, both here and overseas. But 60 Rand invested in the AMC will go to Baobab on day one. On the next slide, 40% of the portfolio will be invested in the Clucas Gray focused equity note, which is effectively a reflection of Clucas Gray's very best local investment idea, 10 to 15 ideas, which Andrew will elaborate on his approach on that when I'm finished. So if you put that all together, Simon, the next slide, this is effectively what you're getting. You're getting 3 different pots of opportunity or potential alpha coming from our best global ideas, our best local ideas, and then Clucas Gray's best local ideas. So importantly, on the next slide, what we're trying to do with this AMC is give people what we think is very differentiated equity exposure. All South African owners of equity, whether it be in share portfolios or unit trusts, have enough exposure to Naspers, Richmond, and the like. We're trying to give them ideas that they will generally not have exposure to. And we're able to do this because both managers are small and lean, and provide that exposure as a portion of a portfolio. We're not by any means suggesting that this should be the biggest part or largest part of a portfolio, but we think it plays a very interesting diversification role, and giving complementary exposure to a more traditional equity portfolio for most South African investors. So if we go on to the next slide, Simon, this just shows you those 3 buckets that I've spoken about and the sorts of some of the shares that we own within those buckets. Outside of this, there will be holdings that would appear in more traditional portfolios, but I think it just gives you a flavor for the fact that, you know, that we own things that won't generally appear in the average portfolio of a South African investor. So again, not trying to be different, but prepared to be different and take advantage of our size and our niche expertise in trying to find some of these hidden gems, both in South Africa and internationally. And then on the next slide, so when Baobab decided to launch this AMC, the question is, why did we choose Clucas Gray as a partner to manage the 40%? And the main reason is Andrew and I have a very long-standing personal relationship, so we've been friends and sort of semi-investment colleagues for a long period of time. We both love value-conscious investing, and it's something we've spoken about together, even though we operate in independent businesses for 20 or 30 years. And we've sort of observed that while we have very similar philosophies, we tend to end up in slightly different sweet spots. So we both have the same beliefs about what drives investment returns over time, but our portfolios end up being slightly different based on our particular personalities and skills. And we just found that when we combine the best ideas of each of us, it tends to end up in a fairly compelling combined portfolio. So we're not sharing ideas. The ideas are individual, but when you put those 2 individual best ideas together in a portfolio, we think it provides a very compelling combined portfolio for investors, and that is what AMC 009 is. So just on the last slide, yeah, that sums it up. It's the best ideas of 2 active, small boutique managers that is available in one easily accessible portfolio on the JSE. And yeah, so that's the intro and Baobab side. And then Simon, perhaps pass over to Andrew to talk about Clucas Gray, who manages the 40%, as I've alluded to.
Quick before we let you go there, Sandy, a couple of questions coming
Sure.
in. I love the imagery of Boabab, the epic trees. I went up, just as an aside, in northern Limpopo. I saw one that is 3,000 years old, which is just staggering.
Yeah.
2 questions came in. The first is around, if you're in the smaller caps, is liquidity a concern? And I suppose it might be, but it's something which you just need to manage as the manager of the fund.
Yeah. Look, the fund and across our portfolios, we're very small managers, so liquidity is not a concern. If it is something that is of a concern in a particular instrument, we will manage that through position size. So, if we think there is liquidity risk in a particular position, we will just manage that through position size. But no, liquidity is not a concern.
Another question came, in fact, one's also just popped up from Sean, but Sean, I'll get to you in a sec. Someone just said, what do you mean bottom-up investing? And I'm going to give my 10-second elevator pitch, and then Sandy, you can mark me on it, which is essentially bottom-up is looking at individual stocks, whereas top-down you would sort of do filters and look at geographies or sectors. You're looking at individuals and doing the hard work at company level rather than big picture.
That's 100% right. Everything we do is we're looking at companies. We take into account the top-down macro issues, but we're looking at companies. And what I try to illustrate there is that because in the Baobab portion, we're looking at both local and global companies, we still rate those on an individual company basis. We're not going to put more of the fund, more of the portfolio offshore because we think South Africa is not going to do well as the rest of the world. If we can find good opportunities in South Africa, Europe, Asia, or America, we will invest in them, but it'll be based on a purely company-specific basis and what we think the return profile of that particular company is, that individual company.
Oh, sorry, that's my computer ringing. A question coming through from Sean, which I thought was really good, and then my questions disappeared. There it is. Sean's asking, at a portfolio level, how do you manage risk overlaps between the different managers when we're doing bottom-up portfolios?
Yeah, that's a very good question. So we considered that when we launched the product, is what happens if there is overlap in holdings, and we decided that we don't want to be restrictive on that, because if there is a holding that we both like, hopefully that means it's a very good idea. What we have found to date is that the number of the overlap between the Baobab and Clucas Gray has been limited to probably 2 or 3 counters, and what we decided to do is not place constraints over that, because hopefully that means if it's a high conviction idea of both managers, if the portfolio has slightly more exposure to that, then we're happy to live with that.
Gotcha. Another question from Sean. He's saying, what is your benchmark and how cognizant are you of it by managing the different company exposures?
Yeah, the benchmark is a simple one, is to beat the JSE, and neither manager is cognizant of it in the way that we pick stocks within the portfolio. So what that means is, because we're both completely benchmark agnostic, the returns of the AMC will be more lumpy than the index, and it will zig when the index zags. But effectively, that is what we're trying to do with this product. We're not trying to give you something that is similar to the index. We're trying to beat it over the long term, and we're not going to pay any regard to what is in the index when we pick the individual securities within the AMC.
And also the space where you're operating, to your point around the Nasdaqs and the Richemonts, you are going to be 100 miles from the sort of the JSE market as a whole. No more questions coming through from there. Sandy, appreciate. Andrew, let me pop up your screen and move that back and hand over to Andrew.
Great, thanks, Simon. Thanks, Sandy, for the discussion on the AMC 009. So the AMC 003 is a component of the ANC 009, as Sandy's alluded to. The next slide, I guess, takes us through what got us here. So the Clucas Gray Equity Fund has been running for 14 years, and it's a very focused, high conviction equity fund which has 25 to 30 shares. That's the equity unit trust, and we've just done a lot of, I guess, looked at studies over the years that have been done globally and domestically on the power of conviction over time, and we figured there was a place really blend with the more traditional products, the larger unit trusts, the indices, to find a way to invest in a very focused mode. So it was, we had this idea of investing in 10 to 15 shares, but it's a very difficult mechanism to implement given the regulations around a CISA and the like. We did find a solution which we launched in December 2021. It wasn't first prize, but the capability was with the idea of trying to have a very focused equity offering of our best ideas. And then the AMC structure through Standard Bank came up in the back end of 2022, and that's when we launched the formal one. So you'll see when we go to the track record, we roll the capability over the last, give or take, 3 years. And I think, you know, this comment that we make, you can find many quotes to back you, but you know, ultimately, to outperform, you've got to look different, and we think these notes, the Boabab 009 and the 003 are really very differentiated offerings. So we wanted to have a concentrated portfolio, sufficient conviction to outperform over time, limited number of holdings, the ultimate objective being alpha. So I think that's probably enough on that slide. We've spoken enough about why the indices in South Africa are concentrated and the ease of access of these AMCs. So just quickly on what we look for, we're looking for businesses that can outperform in earnings or grow their earnings over time, because it's statistically proven that the bulk of equity returns over time are driven by earnings. But what is an equally undisputed fact is that there are points in the cycle where the change in valuation multiples has a seismic influence on total returns. And we've back-tested quite a lot of that over time, looking at some key times and periods in the market where this re-rating potential has been a significant drive of earnings. As a house, we're valuation obsessed. Sandy alluded to it. That's the meeting of the minds between the Baobab and the Clucas Gray approach. We do focus a lot on valuations. And we just think that the landscape, for all the reasons that Sandy mentioned, the landscape is very well suited right now for patient capital to look for what we call underexplored opportunities. So if we go through the presentation, I think maybe just the order of some of these slides may be slightly out, but if you look at the next slide, Simon, I think if we go back a step to periods when, recent times, when going into the elections in May 2024, there was effectively South African assets were for sale. There was just no interest. There was lots of uncertainty, a lot of it political, some of it economic, but lots of uncertainty around. The formation of the National Unity Government led to a relief rally in many ways, and you saw that period from June to October where share prices moved very strongly in the domestic markets. But what's astounding to us right now is we're back below where we were in many cases in May 2024. So we find the landscape extremely exciting. If I look at the next slide, which I'm going to pause on some of the names. We put this together during the course of the last week, just trying to get a sense. We took 6 shares that have been listed for 20 years, and we chose, it's quite difficult to choose 6 that haven't changed materially, that their business models are largely intact. The offshore expansion has been modest. It really is businesses that are very similar to what they were in 2005. And we took 6 shares, and we took the average multiple of these 6 businesses. These are forward PE multiples. And to us, it's very interesting to see that this period we're living in, as frustrating as it's been for active managers, is now as cheap as it's been. The market, these 6 shares are as cheap as they've been since 2008 in the financial crisis, since the COVID crisis in 2020, and then now, as I showed you in the previous slide, they're cheaper than they were in the build-up to the election. So I just think that's the landscape. It's as frustrating as it's been. We all know some of the reasons. Sandy touched on them, from a lack of interest in smaller cap companies, an obsession with the large index heavyweights, the performance of some of the tech companies that the high street guys alluded to, the performance of the likes of gold. These things have really driven the index and driven a lot of the investor focus has been there. But this complete lack of interest and apathy, I guess, towards some of these smaller names makes it a very interesting feeding ground for active managers. So these sort of slides excite us because we know there are lots of opportunities, but they frustrate us because it's been a painful journey getting to this point. So if you go to the next slide, we kind of understand why we're at this point, and this is the only macro slide we've got in the presentation. The fact is that our bond yields in this country are high. Without getting technical, the higher your interest rates, the higher your cost of capital, below your PE multiples. There is a link between that, and we just know we've been living through this period of very restrictive interest rates. We are of the view that some of those dynamics have the potential to change quite dramatically. But be that as it may, we're just focused on the underlying company valuations and look at the way we've been able to build a portfolio. The portfolio we've constructed, in our view, on our estimates and using some of the consensus estimates where appropriate, the weighted PE multiple of the AMC is a 7x multiple with a dividend yield of 6%. The way we look for prospective returns out of a business, there are three major things that drive a business. It's the earnings growth, which I alluded to earlier. We think with the GDP of this economy largely improving, it's been a false start a number of times, but the macro indicators are that the environment's getting relatively easier for companies. With that as a backdrop, we're expecting modest real earnings growth of give or take 9 or 10% earnings growth out of this business. We've got a starting yield of 6% from a dividend, and the remainder of the prospective return we think could be driven by a more normal PE multiple, a valuation multiple for this basket of companies. And that's why we think that the prospective returns from current levels for these 15 or 16 shares is particularly interesting. If you look at the next slide and we go through some of the names, it's always risky showing names because everyone's got their own view on companies. But I think the point to make here is if you look at the names on the left-hand side, well, first you look at the pie chart at the bottom, you can see the split. We have about a third of the portfolio is made up of companies with a market cap above 60 billion, which would be, I guess, top 40 type shares. Those are largely financial shares, which we think are extraordinarily attractive currently. About a third of the portfolio would be made up of mid caps between 10 and 60 billion. You can see some of the names on the left-hand side, but it's the grey block. There are smaller cap companies where we just don't think you get an ability to buy these outside of structures like these, as Sandy alluded to in the 009, the Baobab 009 AMC, and implicitly through that into the 003 AMC. So if we go through some of these names, we think there's a mixture of drivers to catalyze the potential returns. I alluded to just the valuation metrics on some of them. We think that there are 3 or 4 of these names that have an ability themselves to relook at the group structure, to relook at their capital allocation, and to unlock significant value for themselves literally in one sense announcement effective. It could be African Rainbow spinning out a material subsidiary of theirs. It could be Caxton doing exactly the same. We've seen the likes of Ethos selling down assets and repaying. The plan is to repay their NAV to shareholders. We've seen a nice rally in that over the last while. Metrofiles recently announced a cautionary, and we can go through the list. We think there are a number of companies here that have this ability to really drive a value unlock themselves, because the starting valuations are so low. So it could be through buybacks, it could be through changing the group structures, and we've seen a number of these companies on the journey towards unlocking some of that value. So there's the performance of the capability. I explained up front how the capability was formed. It's been frustrating, I think, in the last, since the AMC was launched. It's done fine, but you know, relative to the capped SWIX, there was a period where it was outperforming the capped SWIX quite strongly. That's unraveled a little bit in the last while, with some of the large heavyweights in the capped SWIX performing strongly, and some of these shares, as I alluded to, really struggling. But you know, as I said to you, as we said earlier, the landscape is exciting. The journey to get here has been a little bit frustrating. And I think the final quote that really sort of resonates with us, we've used it a few times in various fora, is this comment that alpha resides in the lonely canyons of despair and mockery, and hence you know, I think it's exciting for us, Sandy and I, and Grant, who manages the AMC with me. It's exciting to us to see some of the opportunities, and we're pretty optimistic about the potential for these structures to deliver good returns to investors.
Does that mean we all end up going crazy at the end of the day? Which it might be where it ends up. Andrew, appreciate that. I've got some questions coming through. The first question, Andrew, is, and it was kind of, I think, answered in your last slide. You are focusing local. There's no offshore here at all. There is some offshore in the Boabab, but you focus local.
Yeah. No, and that's the equity fund is a completely local equity fund, the unit trust. And this is, as I said in the beginning, this is to try and find a way to take slightly differentiated holdings than that, but amplify them. But largely the thematics we're playing in both funds are similar, and it's SA-only capability.
Question coming from Sean, and this is a bit of a big picture, but I'm sort of going to scale it down. He says GDP ratings on South Africa being downgraded. We've seen IMF, we saw Moody's yesterday. What are you looking for in our economy to sort of kick some growth going? I mean, the obvious is that Eskom is by and large working, which is, I think, a huge deal. I mean, is it rates? Is it what is a catalyst that would make you smile a whole lot?
I mean, it's a good question, Sean, and without getting too macro about it, the reality is we have endured a very, very tough backdrop for a sustained period for all the reasons that everyone on the call will understand. We've had the power issues. We've had a very penal interest rate policy. We've had a weak currency, which has driven inflation, which has driven interest rates. And I think we've had a frustration around this lack of activity in some of the public works and the real GDFI spend. We think that the noise is coming out of the authorities around embracing private capital to help with the much needed capex plans in this country is encouraging at a sort of bigger picture macro level. You know, you've had a private sector that's cash flush, it's well documented, the balance sheets are strong, and you've got a public sector that's quite stretched. There's a meeting of the minds around that. That's the one point. The other point is the fact that simply, you know, the load shedding is no longer in the base. I know that's an old story right now, but we're only sort of 1 year into a sort of consistent power supply. And then I think the one that really unlocks the consumer economy is this an end to some of these penal interest rates that we've been living through over the better part of the last 3 to 5 years. So there are a few issues. I mean, we're not looking for. There was a big headline that GDP has been downgraded. We're not trying to forecast earnings in the back of GDP. We're looking at underlying companies, and we just think each of those companies, it's not a stretch for them, given the difficult operating environment they've been operating under. The earnings bases are quite suppressed in many companies. So for them to grow earnings at 8 to 10%, which on aggregate is what we're showing, we don't think that's a massive stretch, and we're not being overly bullish in terms of an earnings story. But I think once they start showing signs of growing that earnings base, off these current valuation multiples, we think that the combination of those two, coupled with a very elevated dividend yield, has this potential to deliver some attractive returns.
Yeah, it's that re-rating as well. And that slide that you showed, I mean, we are at levels when we had a global pandemic or global financial crisis. And we don't have either at this point in time. I'm not seeing any more questions coming through. I'm going to park it there. Huge thanks, Sandy, Andrew, Christopher, Charlie. Appreciate your time. Ladies and gents, appreciate your time in the webcast this morning. We have recorded. It will be up, let's say, late this afternoon. And we'll be back again next week with more managers. Gentlemen, really appreciate the time. Thank you.